Welcome back to Tackle Trade's halftime report, and we're on February 18th of 2020. Welcome out to the halftime crew. We got a lot to cover here today, and that's what I like to see our crew doing. They come in here before we even start talking, Noah, they just go ahead and start liking it before they even hear what we say. I like that. I like to see those likes going up. Muhammad and everybody else, welcome out to the halftime report. Coach Noah, Coach Mark here with me today. I want to start with Coach Noah. Coach Noah, how you doing today, my friend?
Matt, it's an absolute privilege to be here. I'm always happy to be here. It's exciting. I love the halftime report.
It's fun because in a lot of other of our webinars and the content, we put out so much content over there at Tackle, our blogs, our scatter reports, all of our webinars. We do so much teaching. Whereas in the halftime report, we can just come in and analyze, right, and have conversations about what's happening in the market on a daily basis. Coach Mark, how you doing today?
I'm not too bad. My cat loves Zoom.
Wow, you actually gave me an honest response on a question of how you're doing.
Well, my cat, like literally whenever we're having a meeting, whenever I'm on Zoom, she is like, I want to see these people.
I think she likes my voice.
She might, like, she's just like, she doesn't do this normally.
I'll tell you, Chucky, for a rough and gruff type individual like you, who's A-type direct, kind of cute with the little cat, climbing on your head.
It's quite endearing. You should knock that off.
Cats are awesome. If you don't like cats, then we got issues.
This is true. Well, guys, let's get right into it here today. We got some news to talk about. First of all, let me just kind of walk through some economic data that we did get here today. First and foremost, Japan reported Q1 GDP, or excuse me, Q4 GDP here recently. And they came in at a negative number, 1.6%, annualized a negative of 6% growth. Now, that's not shocking coming out of Japan because they have a recession like we have quantitative easing. But at the end of the day, that is a very concerning number and something that, kind of goes into the narrative of the coronavirus and how it's going to be impacting from an economic factor. And with that said, European economic data came out today as well. German economic sentiment just completely obliterated. I believe the number was supposed to come in at 25 and it came in at like 7. So a really big negative miss on German economic data. Car registration data out of the UK, Italy, France, and Germany all fell as well. And that brings me into something that is really important for the US stock market, and that is Apple stock. Let's go ahead and look at Apple. And most people are familiar with what kind of the news that is happening on Apple. But Apple came out last night and they basically warned on an earnings miss as related to what is happening specifically within China. And I want to get Mark's take on that, because this isn't the first company we've seen warn about the coronavirus, but it is the biggest of the bunch that have warned about the coronavirus. And Mark, you and I have been talking about this on the halftime report. We've been talking about it in the podcast about how this situation, this health situation, can have an economic impact. What was your take on the news on Apple?
Well, literally, if this surprised you in any shape or form, you haven't been watching the halftime report or listening to the Trading Justice podcast, or just not applying common sense.
Which I think is the biggest one, the common sense. Like the Fed can't cure a disease, right?
Like,
you mean to tell me paper assets cannot cure coronavirus?
Maybe there's some people that believe that, but I don't think Mark does. Mark, finish your point.
No, I mean, it's like companies, whether it's oil or copper or companies with exposure to China, everybody agrees that whatever the coronavirus becomes, however far it spreads, it is going to have impact on the Chinese economy. It is going to have impact on regional economy, and that is going to impact products such as oil or companies with exposure to, such as Apple. They're just the overall demand. Like, this is a given. This isn't speculative. This is a given. Now, how big that demand goes, as that number continues to climb, as the total deaths continue to climb, it is going to have an economic impact. Mm-hmm. Now, world economic data was already crappy. Yeah. Going back to the final quarter of 2018.
Can I speak to that real quick?
Absolutely.
The entire narrative of 2019 and why the market rose so much was twofold. That we were going to have zero growth in 2019, but growth was going to return in 2020. And Noah, if you'll go back a year ago to Apple, if you guys remember, Apple did this a year ago as well, when they warned of, they weren't gonna hit their price target last year, or their revenue targets and their EPS targets. But instead of, the coronavirus coming out of China, they blamed the trade war kind of coming out of China. And after that, Apple rose a whopping like 86, 87%. We see a very similar situation happening today. But now that narrative, Mark, where's that narrative going to go? Are we going to now just say, okay, growth's going to come back in 2021, 2022, 2023? At what point is global growth going to actually play a role in this marketplace?
I don't know. like I laugh because, I mean, like Noah and I, when we did the halftime report last week, we talked about the battling narratives. This long-term, the Fed has the market's back, powerful narrative that's been fueling the market for the last 14 months, and in a longer time frame, the last 10 years. And then you have your short-term impacts, such as the coronavirus, these narratives that compete. Economic data can certainly start to get into the conversation there. And so it's like, on one hand, you don't fight the Fed, because that's been a losing proposition for over a decade now. On the other hand, you have real life things that logically your brain says, this is going to be impact. This is a little crazy to be at all-time highs with this risk off mentality with these other things. And so, these battling narratives, they're a little perplexing right now, without a doubt.
It's going to be interesting to see what the central banks do over the course of the next year if we do see this have a bigger impact. And Mark, I just have this belief that if you believe that the coronavirus is not going to have an economic impact and the market's just going to chug along the way it always has chugged along, well, then what you're really believing is the data that's coming out of China, is what you're really telling me, is that you believe the data that the Chinese government is putting out there. And I just simply don't believe that. I believe the Chinese government has a lot of propaganda. They're trying to hide some. They have not been transparent in their data over the course of the last 2.5 months in regards to the coronavirus. Again, transparency is important. So the other philosophy is, well, I believe this is going to have an economic impact because I simply believe the situation is worse than what we're seeing out of the Chinese data. So to me, you're always going to have to trade with your eyes. There's no doubt about that. But at the end of the day, I think you have to be prepared about how this can impact from an economic perspective. And, I'm not suggesting that all of a sudden next week we're going to see a recession, but it is going to play out longer term, whether that's, on the back half of 2020 or whether that's into 2021. I don't think anybody in the world truly knows the extent of the situation. I just don't believe that. And so I'm open-minded to seeing what the data is. I want to be data-driven as an analytical individual, but in the back of my mind, like the Boy Scouts of America, kind of a sad day for the Boy Scouts of America today, if you've kind of seen that news, the bankruptcy news coming out of the Boy Scouts. But always be prepared. And so from a technical perspective, I'm going to trade with my eyes, but my mind is going to be prepared for whatever does transpire coming out of this. From a technical perspective, Noah, how does this news on Apple and the gap down on Apple, does it impact the trend or the bias on Apple? Because we haven't broke any support on Apple.
No, we really haven't actually. It gapped down below the moving averages. So it did gap below the 9 and the 20, but it had been chopping sideways for the last 2-3 weeks as it's been pressing those highs, almost forming an ascending triangle. In fact, we even put it on the scouting report in anticipation that it might break out. And in the report, I talked about how it could be a topping pattern as well. But this little gap down didn't really even take out that first pivot yet.
Which is a very minor level of support, by the way.
Oh, super minor. Just, this one down here at 300.
300 is a big one.
And that would have to take out your 50-period moving average as well. But when you get your moving averages pinching in like that, violating a 9 and a 20 in the sideways move is not that big of a deal. Mm-hmm. But again, if it starts breaking one support level and it comes down and tests the second support level, then you might see signs of reversal. The one thing I did notice is that the volume's kind of gotten quiet. So It's dipped down a little bit below average. And so far this morning, gap down. And I wouldn't be surprised to see it fill its gap, even though they came out with that cautionary statement. Mm-hmm. I think that the Apple fanboys out there, fan people will absolutely be willing to buy whatever dip here. I won't be surprised though if it does give us a little bit deeper correction, but I only see that occurring if we see, the rest of the market kind of follow suit. I mean, Apple is a big player. It obviously is probably the biggest fish in the tech pond. But this is one where I have to watch which way it breaks. Either today's high or today's low. That'll give me better clarity. So far, not a big deal.
Well, and they did in their statement, they did talk about how this was just specifically related to China, and that even though they're getting back up and running, it's not happening as quickly as they anticipated, number one. And number two, the concern I have with China is even when the people go back to the job and they go back to the Apple store, is the consumers going to have the confidence to come to the store? I mean, I read a report yesterday that this germ, if even if it's on like a piece of glass, it lasts for up to 9 days and has it and can convert not 1-to-1, but 1-to-4. So to me, it's not just to see if the people go back to the job, but if the consumers come back in. But Apple did state that this was specifically related to China, and they have not seen it in their other countries that they have a large presence in. No, even though the news came out today, and even though we saw a slight gap, Apple down 2.6%, if we do start to see upward movements in price, is that breakout that we were anticipating in the scouting report this week in the options report, is that still a legit breakout candidate for you?
Oh, yeah, absolutely. In fact, it even kind of shores up the pattern a little bit better and makes it look more like an ascending triangle. I was a little worried about it feeling top heavy, but if it manages to put in an equal or higher low and then comes back up and retest that resistance, I think that improves the actual, the pattern, the look of the pattern, just in my opinion. So I think it's absolutely a legit breakout, because if the market's still throwing caution to the wind and we're still, posting new highs elsewhere, where else would you rather be but, in a stock like Apple? You'd want to be in one of the leaders. Yeah. So, that's kind of my take.
And the news not only had an impact on Apple, but Apple does a lot of business with like Skyworks Solutions, SWKS, real quick, Noah, if you'll give me a chart on that. Also Lam Research, LRCX as well. And so you saw, Skyworks Solutions come down about 1.5% today. LRCX had a bigger downward movement in price as it gapped down about 4%. Still in that nice little bullish uptrend, but it did disrupt some of the technical indicators on both of these companies and the semiconductors in general. Let's go ahead and look at the SOX index, SOXX. The semiconductor index got beat up a little bit on the news as well. On average, the semiconductors down about 1.5%. So it did disrupt some of the technical analysis, some of the trends a little bit. Maybe you got to wait for some better setups in that space of the marketplace. But I do want to move on very quickly because we got a lot of stocks in the news today. I do want to, but before we get into the stocks, and we got to talk about, Tesla and JD.com and WWE, Conagra Foods, Netflix, HSBC, Facebook, GM, Kroger, Walmart, all had major news today. AMD doesn't care about anything. And
I just wanted to throw that out there. It's the honey badger of semiconductors right now.
It doesn't care about it.
It doesn't care.
Yeah, I believe that was on the options report, right?
Yes, it was.
Yes, it was. Nice little trigger and run here on AMD. I do want to go very quickly, though, into the commodities market. Let's take a look at crude oil very quickly. Mark, what's your take on crude oil? We're seeing a little bit of a short-term W formation. Tim asked us in the podcast. There was myself, you, and Jake Pelly was a guest in the podcast. So definitely go and check that podcast out. We had a lot of fun. But Tim asked us, are we interested, any one of us interested in buying crude off this W formation we've had in the short term? And it didn't take but 1 second for all of us to say no. Mark, has anything changed between yesterday and today to change your opinion?
Pull up the coronavirus chart in China, and that is.
And the answer is no.
Yeah, I mean, until you see, like, once again, it goes to a philosophical approach to trading. I will be alive X amount of years. Now, I'm going to be actively trading in some form or another every single day the rest of my life. Like, I'm not afraid to sit out time periods on a given stock or a given commodity and wait for greener pastures. You do not have to trade every freaking day to become a successful trader.
Nope.
So sometimes we impose that, like, that like, oh my gosh, I have to do something today, or I'm stuck, or I'm never going to achieve my financial dreams, and I'm going to just be a total failure. No, be patient. Sit out times. This is a nightmare time for crude oil in trying to get a read. The coronavirus is a real, true, genuine, negative, bearish catalyst that until it goes away, I just don't understand why it's just greed or fear of missing out or whatever it may be.
Well, for me, I mean, what I said to Tim yesterday, I said, I'm really going to buy the first retest of a downward moving 20-period moving average? No, absolutely not. But we were concerned about global demand impacting crude even before the coronavirus came out. And now that the coronavirus just came out, to me, I'm not looking to buy here. I'm looking to short underneath that pivot if it ever does break. And so keep an eye on that 49.30 level on crude oil. It's got a nice little double bottom scenario on the intraday perspective. But no, I need to see a lot more evidence before I look to buy crude here. And that includes, maybe even a bullish uptrend with the first retest of support. But to me, it's just a stay away from the buy side. And it has selling ability underneath that pivot point of 49.30. I do want to switch it into the gold market very quickly, guys. Obviously, when you on a day like today where you have like a risk on environment, or excuse me, a risk off environment, gold showing a pivot point and a potential breakout of 1600. We've said in many times in recent history that anything under 1600 was not a new trigger. But if we do confirm above 1600, is that now a trigger for either one of you? Let's first start with Noah.
Yes, that's a good looking setup. I love it above 1600. I really need to see if it can maintain the close, and then you probably take it above the candle high. But that's right there at 1600, 1604, and that if it can maintain that close, I like it.
So for you, you need to see a confirmation candle. You need to see that close, correct?
Well, I mean, close above resistance is always stronger than it just poking its head up. If it just wicks up and ends up closing back down, that means they weren't committed to the breakout. So if by the end of the session, the professional traders have still been buying up there and it closes above that, I think that gives other traders the confirmation and okay to step up and buy as well. So the early adopters are already in. Me, I might not take it directionally, but I certainly like the idea of selling options below it because it does have a nice little a bullish sentiment. And the other thing I see is a nice little uptick in participation on the volume, which just tells me that you got a little bit of, institutional movement behind it. And again, if it stays and closes up above there, I like the signal better.
Increased volume on a close above a breakout channel, that has to be a buying opportunity, correct?
I would think so, unless it goes down, of course, then I was wrong, but I think it's still going to
go. Well, I think we all understand that sometimes we are wrong on the analysis.
Rarely. That happens.
Oh, don't ask Mark. Mark's always right. But in terms of trading, you've got to make decisions based on what you see at the time, based on the analysis you're seeing at the time, and you don't have the luxury of waiting a month for something to set up, or you're buying at the absolute end of a channel. So in my opinion, I think a close above 1600. I'm with you, Noah. I need to see a close above 1600. Trigger would obviously be above the high of the day. That close on an increase in volume, I love what you said there, Noah. It shows commitment, right? It shows that the hedge funds, the institutions, and the people that are driving this commodity on this day or whatever stock or index, that increased volume shows the commitment to the movement. I love that analysis. Coach Mark, do you have anything else on gold? I know Tim has wrongly accused you and I of being gold bugs in the past, but no, we're analysts and we see a breakout. Mark, are you interested in re-triggering here?
Listen, we have been dead on for 14 months. It's an easy, once again, I don't short-term trade gold, so I'm probably the wrong person to ask as a
let's
swing
say
trader.
Like most of our price targets on gold this year, if I remember coming back to the prediction podcast, were anything between 1650 and 1800. And so, I think I was one of the more aggressive ones. I think I was like 1750 or something along those lines. But maybe you're not adding to a position, but let's say, Mark, you're looking to add a position to gold in a portfolio from a position or an investment perspective. And you're doing it not just for the price appreciation, but you're doing it for the protection that gold does give a portfolio as one of those safe haven asset classes. Is a close above 1600, if you're looking to invest or to position into this, is that a legit setup for you?
I would prefer, see, here's the problem with gold. I mean, first of all, I'd rewind 12 months and have all of you buy gold when I was screaming at you to buy gold.
Oh yeah.
Like
we've been very vocal about gold.
Very vocal, so I'd rewind 12 months, but since that is not an option, it's tricky at this point because every time you've waited for opportunities to get back into gold, they've been few and far between. We have not had a deep pullback. We had a slight pullback towards the end of the year last year.
But it didn't even touch the 200-day moving average.
Yeah, we haven't had that deep retracement that a lot of us have been waiting for. Bullish trading signals have generally been sometimes the last opportunity to get in. So the fundamentals are so strong behind gold. I would not criticize the decision.
Well, it's for you, it's a little difficult because you are famously known for buying bottoms, right? You're a bottom feeder,
especially in commodities.
And so as such, when you're breaking out to that high, it goes against who you are to a certain degree in the commodity market. I maintain that if you're not in a position and you're looking to add gold as a protection mechanism, there's far worse setups to add gold than a breakout of 1600, in my opinion. So keep an eye on gold. And obviously, if you don't know how to trade the futures commodity, there's many ETFs, GDX, GLD. Hero says IAU. So let's take a look at some of those charts really quick here. GLD, the breakout would be 150. We're seeing that breakout of 150 on GLD here. It's currently pinging right there at about 150.71. A close above 150 coupled with a close above 1600 on the commodity. GDX would be the gold miners. Obviously, gold miners are not going to run one-to-one. They're not one-to-one correlated, but they do have a fairly decent correlation status. I would need to see a breakout of 30 on the miners. Noah, what do you say from a technical perspective?
Well, for the symmetrical triangle fan in me, I think that is a break. Waiting for it to take out 30, more power to you. But I think as of right now, it's right there where it could take out the top trend line, maybe today's candle high if you're aggressive. Otherwise, I think I agree with you. Maybe wait for it to take out 30, even 31 if you want to be really sure it's taking out that high. But again, this has not got a huge personality. It's a $29 stock with a 54-cent ATR. I'd be pretty comfortable just trailing a stop on it.
Well, and you and I have actually discussed this in halftime reports of the past, how you have these different patterns that people are either like or they don't, right? And a breakout of a symmetrical triangle is a legit technical setup when you break out of that intraday resistance channel. And that's what we're seeing on GDX. The way my mind works, I focus so much on the left of the chart that I'm just like, yeah, but what about 29.50 and what about $30? And let me clear out of some of those resistance. And I've missed out on a lot of opportunities by not doing that because that just doesn't fit who I am as a trader. But you love it, right?
Yeah, I'll take the breakout. So we'll go Noah level down there. I'll take the breakout on the triangle. I don't mind it. Just depends. The biggest problem with that is you get the occasional whipsaw. You'll get a better price, and I tend to be more aggressive on triggers anyway. That's just my personality trait. Mm-hmm. But it's a trade-off because you might get a false signal earlier. You have to have good stop management in place, but at the end of the day, you're going to end up taking a trigger too. You're going to use a stop management. So I'm not so sure how different our approaches are.
I'm just going to wait for a different setup. Right.
Yeah, but it's preference, and we both are using controlled risk. And so, for those who like the idea of the triangle break, just make sure you got good risk management. For those who want to see it break resistance like Matt, well, just make sure you got good risk management. Same thing.
And the setup's going to be very similar in terms of entry versus stop. For me, I would like to see that price appreciate into $30. Give me a nice little high base and then break out at $30. And that might take a week or two to really kind of establish itself. And I might miss out on a really good opportunity, but it's kind of like knowing who you are as a trader is really important. Jake Pelly's been a trader for the last decade in the market, joined us in 2010. And, I asked him yesterday, he's probably had 100,000 trades in the market over the course of the last 10 years. And I asked him how he's evolved as a trader. And he said, you have to evolve as a trader because you got to know who you are and you got to match what the market is doing. And I thought it's just a wonderful answer, but no, how long does it take you? Because we got a lot of new traders with us, right? How long does it take you to really truly understand who you are as a trader?
I think it's continually evolving, and I'm still evolving to this day. I think if you stop evolving and learning, it just you'll stagnate. But it's really important to understand your temperament, and then to understand the difference between temperament of an investor versus temperament of a trader. And if you can hone in and harness both investors temperament and trader temperament, I think it takes a couple of years. I think it takes at least, I'd say the average person spends a year getting familiar and comfortable with the language. They get, their second year really exploring what they're comfortable doing, building their confidence. I think by year 3, you're starting to cook with Crisco, and by the time you hit, that 4 or 5 year mark, you're probably well on your way to a style of trading that you may expand on, you may not. But I think perpetual growth is always in the equation.
Well, and I also think you have to have experiences in different market conditions and different market cycles, right? Because every like the market evolves every 6 months in different trends and patterns, and to see bearish conditions versus neutral conditions versus bullish conditions, I think it just takes time to truly understand who you are as a trader. A few other individual stock news very quickly. WWE got upgraded for some reason at some bank. Tremendous downtrend in WWE, coming off that support level of $40. Did get an upgrade, does not change the technical formation, in my opinion. Still have a nice little bearish downtrend. JD.com, JD is the symbol, also got upgraded here today. Looking at a potential breakout candidate with earnings coming up here. Conagra Foods, CAG, got they downward guidance revision here today, gap down into the 200-day moving average. A couple stocks I do want to get a little bit more analysis on. Tesla.
Well,
Tesla.
we put this in the scouting report, Matt.
Over our stinking triggers.
Gapped over our triggers, and I did a strong disclaimer. This is expert level trading territory, only because you've got a $845 stock, you got a $75 ATR, you've got options with wicked bid-ask spreads.
Wow.
I was happy to watch this one from the sidelines myself. I feel like I missed that run, and I have no desire to chase after the personality of Tesla at the moment. I would love an opportunity to pick it up off a dip or after it stabilizes, but this, in my opinion, I'm having a hard time wrapping my head around the rationality of this price chart. It's a beautiful chart. It's a beautiful setup. Not my cup of tea.
Well, it was a beautiful chart. It was a beautiful setup. It gapped out, and obviously the news was it got 2 banks upgraded it, not upgraded it from an investment. They're still trying to catch up with Tesla's price chart. I forget what the price. I think one upgraded price chart like 550, another like 750. The banks and the Wall Street institutions, they've been trying to just catch up with what the price of Tesla has been doing. The gap out is obviously strong, but for me, I needed to see it close above that with a standard. That gap kind of throws a little bit of wrench into the analysis, doesn't it?
It does, and you could go trade it bar by bar, and this is one of those things where maybe you'd be better off just like day trading stock on comfortable position size, because the option spreads when I've gone and looked at them, Matt, they seem a little difficult. They're not crazy, but there's a lot of premium out there, and if I've got dollar spreads or 60-cent spreads, that's like driving a new car off the lot when you're buying it. And for something like that, I don't love the idea of higher frequency trades. It moves enough to certainly make the premiums move, but it's got a little meat on the bone. So again, not for the faint of heart, for the novice, but for somebody who's got a lot of experience. Knock yourself out by all means.
No, if you're an aggressive trader, you can absolutely trade Tesla to the buy side here with bar by bar, trigger above the high. I just I've been doing this too long. It's not for me. It's not. I just can't chase that dragon. But I also can't blame anybody for doing what they've been doing on Tesla. They have made a tremendous amount of money over the course of the last 3-4 months. So more power to them. I want to see some degree of settle down for a little bit. I wanted to see a nice little trigger above that 825 mark. But obviously with the gap up, it does change that analysis. Moving on, Netflix also got a price upgrade, and it is approaching, it is 52-week high here, guys. We all know it hasn't broken the all-time high. That's at 423. But breakouts of 52-week highs are pretty strong trading strategies. Noah, what's your take here from the technical condition on the price upgrade on Netflix?
I like the break. The only reservation I'd have is I've got a little RSI chart down here, an indicator, and it's showing me it's over 70. Now, a stock can remain over 70 and it can run, especially when it takes out a high. You just have to know going in that if you're buying this particular breakout where it's been running for, it's kind of riding the top side of the channel, and you're getting a breakout. I always love it when it sets up a cup and handle more because I feel like it's a better launching platform.
I think we all hate
Mark in here very quickly.
Yeah, I think we all hate those really big, huge momentum run-ups to a resistance level.
Well, yeah, it just makes me
wanted to pause.
Your average swing trader's like, this is where I should take a profit. And if it blows through it, it blows through it. But when I know that it's in an overbought condition based off of like an RSI indicator or even like a pay range where you go count previous swing ranges and kind of get an idea of how much it moves, or even if you just draw a trend channel, it's at the top of that short-term channel up here, but that doesn't mean it can't go higher. It just means I'd have to take a big, deep breath, hold my nose and buy on a breakout here, and then maybe use a trailing stop, with an appropriate position size. I definitely would much rather have a cup and handle set up because that, for whatever reason, that cup and handle is my favorite pattern of all time. You show me a good cup and handle, and I get pretty excited. You show me a breakout after it's been running up for 10 days. I'm like, maybe I'll wait and see if it turns into a cup and handle. So,
well, kind of how I see this is I'm with you guys. Mark, I'm with you. We don't love chasing the dragon at the top end of a range. It throws off the analysis. How we were all trained as swing traders is at the top end of a range, you're supposed to be locking in profit, not adding to a position, right? So in terms of this, it just goes against our DNA as swing traders. So we'd like to see something occur when we see stocks that we're looking at potentially adding a position to, whether it's a swing trade or position trade or whatever the case might be. You want to see either that cup and handle form, which would be that, it would hesitate here, come retest that support level, whether that support level is at 350, 360, we don't know. But it comes down and it retests that level. And what happens as it comes down and it retests those support levels, again, 350, 360 is kind of where I would be looking at. It basically that RSI comes down, and then instead of running a marathon coming into that breakout channel, now we're only running a sprint coming into that breakout channel. And so it kind of resets the RSI indicator to give you a little bit more room. That's number one. Number two, you want to see a high base type scenario where you don't get that retracement. You basically just consolidate for the next 4, 5, 6, 7 trading days. And again, by consolidating, that RSI comes down again, and then you break out of the RSI. And in the third scenario, if Netflix does, just go parabolic on us, runs into that 400, 420, it gets overextended. And then you see that retracement into that previous old resistance channel, now new as support level. And that's what you're looking at. But I don't think you chase the dragon here. You be patient. You let it set up first and foremost, but definitely have Netflix on a watch list. This is a company that's done really good over the last 4 or 5 months. And we're starting to see that price appreciation break out of the 52-week highs. Keep an eye on how Netflix behaves over the next week to 2 weeks. Next stock in the news here, HSBC, the bank that nobody likes, and nobody's going to like it even more after we get through with the analysis. HSBC announced a restructuring of their bank to where they're going to be laying off 35,000 employees. Once again, think about that number, 35,000 employees. They're going to basically get rid of $100 billion in assets. It's going to cost them $7.2 billion in this restructuring plan. And the kicker, no stock buybacks. Oh my God, that's like taking, steroids from Mark McGuire back in the day. No buybacks for the next 2 years, but they did not cut the dividend. They cut the employees. They didn't cut the dividend. HSBC coming into that 52-week low, threatening a breakout here. Noah, is there a potential short trade underneath 35.35?
That's such a big support zone for it, Matt. If it breaks, yes, I think that there's that potential. Now, normally layoffs can stimulate a stock. Like when they talk about
layoffs are bullish.
Yeah, it can be bullish because all of a sudden they've got a reduction in their expenses. It's always cold-hearted, in my mind when markets respond positively to layoffs. but I'd have to dig a little bit deeper on it fundamentally. Technically speaking, it's ugly. I mean, it's ugly. It's got a bit of a gapping personality.
Well,
That's probably my biggest turnoff. Yeah. But otherwise, if it breaks a support, and when support breaks, you can feel pretty good about going.
Let me get a weekly chart on HSBC here. That's a big time break.
That is a big break.
Mark, what's your take here? Is it shortable underneath 35.35?
It's so hard. I mean, companies like this, there's some real negative narratives here on HSBC. So normally I pause on banks after they've been beat up, but I think this is kind of the exception to the rule here.
Yeah, and it's a company that deserves a short, to be quite frank, especially after laying
I
off
think there's enough juice behind the narrative that it could be a nice little short trade.
Yeah, and kind of like that Netflix kind of, you don't want to chase it after a gap down on earnings. Let's kind of wait to see how it sets up and how it behaves at 35.35. And I don't believe you can short it above 35.35. But underneath that, there's not a lot of support. And we all know, guys, regardless of the tradable instrument, once not minor support gives out, but once major support on weekly charts or on monthly charts give out, man, you typically see, not all the time, disclaimer, not all the time, but you typically do see further price depreciation. So keep an eye on HSBC around 35.35. Next stock, Facebook here. Facebook's in the news here today, and it's been in the news for a while based on European regulations. And this is one of the only big tech companies out of the US that does not have regulations on it, such as Microsoft and Apple and Google from a regulatory perspective, controlling monopolies, stuff like that. They were negotiating with regulations. Mark Zuckerberg says yesterday he welcomes regulations, put a proposal to the Europeans, and the Europeans said it is not good enough. It does look like we're going to be seeing regulations come out on Facebook. Obviously, regulations have not impacted these tech firms. I don't think it's going to impact Facebook either. What's your guys' read here?
I like the chart. I like the break. I like the close. The only thing I wish it had more was a little uptick in volume, but that's a pretty good looking higher low, a W type breakout, and the close close to the high. So there's room, there's room for you to maybe leg into something, or you could wait for it to break the high. But I like the chart. I might already be in.
Let's.
Are you trying
to front run though?
Listen.
No, definitely not. No.
One thing to be aware of on companies like Facebook. Facebook's one of those big millennial type brand names. And on these companies, look at the run that Apple has had. Look at the run that Netflix has had. Look at the run that Tesla has had. If Facebook can get some juice behind it, just look at some of these other, and let's forget fundamentals and all that, because none of that even
fundamental
matters.
Doesn't matter until the market crashes.
It doesn't. And so like a name like Facebook that's been fairly stagnant. Price isn't a whole lot higher than it was, 9-10 months ago. If a company like this can get some run, can get some juice behind it, these are the type of potential trades that can really, really impact the bottom line. These are the type of directional trades. So I think you have to put Facebook front and center on your watch list. Wait for the setup you're looking for. Use the strategy and not spreads. If you did a spread on Tesla, if you did a spread on Netflix during this recent run up, if you did a spread on Apple, what did you make? You made a little bit. Nice trade. Great. Yeah, these are the type of goal for the directional type trades that can really impact.
So you're saying open-ended risk graph.
I think he said buy out of the money calls. Yeah, I think is what he said.
I think he said load up 100% of your account on out of the money calls. Is that what he said?
I think that's what he said.
That is not what I said.
Oh, okay. Just double checking. All right. Just making sure.
Clarifying.
Well, listen, Max Loss will come and put a bullet in your ass if you do that.
Yes, he will.
Also, GM is in the news here as well today. GM is pulling out of Australia, New Zealand, and Thailand. It's going to cost them about $1.1 billion in cost to pull out of those. Gap down on the news, but there's really nothing to see here on GM. Agreed?
Pretty neutral. Nothing exciting.
Something exciting happen to Kroger here today, though. KR is the symbol. Kroger spikes on none other than Warren Buffett, putting an additional stake into Kroger. And this is the Buffett impact. No, obviously, I don't see a trade here at all. But no, I do want you to just speak very quickly to people like Buffett. and when they do something and how it does have an impact on the marketplace?
Well, I mean, his level of influence is without a doubt, like no question. I mean, I can remember going back to 2008 crash, Warren Buffett saying he's buying GE at 6, and then everybody else decides to go run out and buy it and runs the price right up for him. It's a good gig to have if you can get it. It's not hard to be an oracle when you announce that you're buying something and everybody else decides that's a great idea, and then they go run the price up for you. The key is you just got to buy first. Now,
that's what Buffett gets. He gets the ability to buy it first and sell it first.
Well, but you look at his game plan, he's really more interested in the cash flow from that. I mean, you go look at, they're paying a 16-cent dividend. And if you go look at like how much they're paying out in revenue for their dividend, oops, I didn't mean to pop that up. It's a decent little company to own. It's a cash machine for him. Plus he knows how to write covered calls. He knows all about the premiums. So, for somebody like Warren Buffett, I think it's something he would believe in fundamentally. And then the price gap's just a benefit from that. And, the rest of you would want to look at it from the same perspective as Warren Buffett. Why is he buying it? For fundamental reasons, for cash flow reasons. He likes dividends, likes the idea of, the ability to sell option premiums. And, little gap up on the news, that's just like cherry on top.
He's a value investor, and he bought a value stock that is in a conservative sector, that is a cheap food-based company. What does that tell you, Mark?
Well, that's pretty much textbook, right?
that fits. That's textbook 101 for Warren Buffett.
Yeah, Kroger, huge brand name in the space, huge established company. Buffett is he's just a value investor. He's just a stable investor. He is not apt to go find the next hot penny stock. He's going to be like Kroger, been around forever, reasonable price, reasonable cash flow.
Buffett's not momentum trading Tesla, right?
No, but I'll tell you what he's getting out of this. He's getting a 2.27% dividend yield, a ratio payout of the revenue.
He might be getting higher than that.
27.34% is going out in dividends, and then they've got an 11-year growth track record on dividend.
With a 14 PE ratio that is half of what the average market PE ratio is.
Yes, so it's a value play for sure.
Yeah, definitely.
And those are boring. It's like watching paint dry, except for over time, it works miracles.
Yeah, and again, you don't want to build a portfolio around just sexy stocks and growth companies, because what happens when growth stalls and what we've been seeing over the last couple of years, those growth companies have still been going up. But again, we saw growth stock coming out of the Asian currency crisis in 97, 98. And yet the stocks in the market still had price appreciation for the next year and a half, 2 years before we topped out. So, it's a value play, and value stocks play a role in a portfolio. They pay you a dividend. You can cash flow on covered calls without the aggressive trade management, and they cover some of the riskier assets in your portfolio as well. I can see exactly why Warren Buffett is doing this. Moving on to another value stock here. Walmart reports earnings today. And let me give you kind of the headline numbers, and then Noah break it down from a technical perspective. EPS numbers came in at $1.38 versus the expectation of $1.43. Slight miss on EPS numbers. Tosh had the EPS estimate actually at 146. I had it at 143. I got mine from earningswhispers.com. Came in at 140. This is just Walmart. They sold $141.7 billion worth of goods. The expectation, however, was 142.7, so a slight miss on revenue, but not dramatically. Revenue up 2.1% year over year. Guidance was slightly down, but not by much. Came in at about $5 to $5.15 on the year 2020 yearly number. The expectation was $5.20, so it's just slight miss on guidance as well. A miss and a miss and a miss, all very, very small, not big time misses, not to be concerning. Walmart still goes up on today. Noah, what's your read from a technical perspective?
Well, from a technical perspective, I love that 200 period moving bounce. I love that it's closing back up above all of the moving averages. I like that it's also approaching a resistance, which makes it tough to want to buy at this very moment because it's right there knocking up into that 120 high with the all-time high out there at 125. But again, even after, slightly disappointing miss, again, it's like taking second or third place in the slam dunk competition, not first place. they killed it with revenue. They just missed their
Pretty
estimates.
good, right?
Yeah, it's pretty solid. So if you can catch a breakout on that, no concerns. Again, a dividend paying stock, it's Walmart. I mean, it's hard to, you don't pick a fight against it.
Well, and again, I just come back to, if we do see concerns over the coronavirus causing that next global, economic event. And again, we don't know. We got to let that play out in the future.
Well, and I think the
Let's
Walmart might have some exposure to the coronavirus and China stuff, since obviously a higher percentage of their goods come out of China, but doesn't seem to be affecting this chart.
Well, and also if you go back to when the end of the world happened in 08, because that's what everybody thinks every time we go through a recession, the end of the world happens. It's insane, but that's what they think. Walmart actually had price appreciation in 08, whereas the market went down 57%. Walmart went up like 22% in 08. You can kind of see it in that price.
Well, and think about that. People who, in a recession like to be all hoity-toity and say they're too good to shop at Walmart, end up shopping at Walmart.
The elitists who love paying a higher rate at Whole Foods or Sprouts or whatever, they find themselves at Walmart.
Yep, they do.
They just do. So keep an eye on Walmart. That breakout of 120 could be potentially adding to a new position. That's really a couple other stocks. That's about it, actually, in terms of the stocks. The last thing I do want to talk about is just I just want to get you guys' take on something. Michael Bloomberg has released many plans that he's going to, obviously Bloomberg's running for president out of the Democratic Party. He released a plan today, and I'm very interested in seeing Bloomberg on the debate stage tomorrow night. He did meet the parameters to get on that Nevada debate stage. So I'm excited to kind of see how he interacts for the first time with the other candidates. But the thing that he released today was very interesting to me, and it's very similar to what we've seen out of some of the other Democratic candidates. Bloomberg released his plan to rein in Wall Street. Now, before I go through the list here, I do have a fundamental belief that we should rein in Wall Street and that the over-leveraged nature of Wall Street should be combated to a certain degree. But he vows to strengthen the Dodd-Frank Act, which was the act that came out in 2010 that basically put a lot of regulations on the Wall Street institutions from over leveraging themselves, using the bank's money in speculative assets, writing bonds against debt incurred on subprime loans and so on and so forth. He also promised to strengthen the Volcker rule, which is the banks not using their own assets in prop trading and aggressive speculative asset classes. He also reiterates and restores the funding to monitor bank riskiness. Right now, the central bank is the only entity that really does stress test in the banks. We've seen what they've been doing with repo actions. He also says he's going to bring back the Department of Justice to criminally prosecute individuals who break the laws and the regulations within the Wall Street institutions. And Mark, I want to get your take on this. He proposes a 0.1%, 0.1%. He proposes a 0.1% financial transaction tax on speculative and prop trading firms like hedge funds and so on and so forth. Mark, this is, I don't want to get into specifically on Bloomberg and what Bloomberg is doing, but what is your take on regulations for Wall Street, if we should increase regulations or just let Wall Street do what Wall Street does?
Listen, my general political and philosophical stances on society and freedom and all that are going to come through here. I better see a damn good reason to ever support any regulation. Now, are there times I am not a total libertarian? Let's live in the Lord of the Flies world. No,
you don't like anarcho-capitalism? Sweet,
Lord of the Flies. Boys running around without their shirts looking for Piggy, if you get that literature reference. But there are time and place for regulation. Environment certainly comes to mind, where you can't just let companies destroy the earth for future generations because of a philosophical stance. This seems like pandering to the public to me. Mm-hmm. I haven't, went into every detail of the thing, but, like more government is usually not the answer.
I agree. Mark, I'm right there with you from a civil liberties perspective, because anytime in our past, we have given up civil liberties, we don't get them back, right? It's easy to give up. It is impossible to get back. So I agree, but I do believe that we have to have honest conversations in our society about what banks are allowed to do and what they are not allowed to do. A bank should not be able to loan out a predatory loan and then write a bond against it to cover the risk of their asset and then put that bond into the consumer's hands, meaning the consumers carry their own risk to default, which allows banks to over leverage themselves and loan out as much money as they can, and then have the central bank come in with $800 billion in repo actions to bail out those same banks from over leveraging themselves. We have to have conversations because that's not good for consumer society. And so I agree that it's a difficult conversation to have, because anytime you introduce a regulation, you are going against certain economic factors and limiting certain economic factors. But I come back to the foundation of capitalism, guys. And in the foundation of capitalism, it was not a, to your reference, Mark, it was not a Lord of the Flies economic scenario that Ayn Rand painted in Atlas Shrugged. It was, okay, we wanted to foster an environment where supply and demand controlled the price. And if you created a good product with strong demand, price went up. And that would encourage other corporations and other entrepreneurs to compete in that environment to drive price back down. And supply and demand controlled the price. But I think we can all agree that over the last 10 years, with what we've seen out of the government's response in the TARP Act of 2008, 2009, where we bailed out the banks, we bailed out corporations, and all the quantitative easing of $4.5 trillion in quantitative easing, and now all the repo actions, that Wall Street and the central bank have simply have changed the way capitalism drives price, where the Fed drives price instead of supply and demand. So I get it that it's a difficult conversation, but it's a conversation that absolutely needs to be had so the banks don't take advantage of consumers. Noah, what's your take on it?
Well, I mean, it comes back to the old fox watching the hen house analogy. And, if we're going to do it to Wall Street, now do the Fed, now do the FOMC. I'd like to see some regulations on what they can and can't do.
I'll get my torch and I'll go with you.
Well, and that's the pitchforks and torches are coming. We've talked about this in the past, where the biggest problem I see with it is, one, the risk, because it does create bubbles that pop. But two, it also creates greater separation between the haves and the have-nots, because if you have assets and you're benefiting from these bubbles, great. If you don't have assets and you're trying to get into these things, well, that raises the bar quite high for people who are wanting to get into investing. And I do think that, there is room for safe and sane regulations. I don't love the idea of a transaction tax, because that might slow down and hamper price discovery.
Isn't that
at the same point in time? What else? But what else do you do about algos? I think the battle against the machines is here and now. And for a swing trader, it's probably not the biggest deal, except for when volatility kicks in. And it's probably not the biggest, deal for mom and pop investors who are having a, 1/10 of 1% tax added to their transaction, but it does add up over time. And I'd like to see some regulations, and I honestly wouldn't be opposed to things like, banning algorithms and things like that, bringing it back into human touch.
Well, and I just want to specifically speak to that, Noah, because that 0.1% transactional tax would not have an impact on Mon Pa America. It wouldn't have an impact on 401ks. It wouldn't have it. And I don't even think it would have an impact on individual traders like you and I and Mark in our community. It is attacking the hedge funds like Citadel. It's attacking the hedge funds who, by the time you blink your eye, they have 30 million transactions in the market.
Yeah. And I mean, again, I'm open to it, and I would also be open to changing it if it doesn't work. So that's kind of the thing.
100% agreed. 100%.
It needs some flexibility. Anything you implement has to have some sort of, statute of limitations. Say, okay, we'll try this out for the next 2 years, 5 years, whatever it is. See how it goes. But there's got to be a revisit, because, like you say, anytime you give up those liberties, and you give up, certain financial freedoms, they're very, very difficult to get back.
But if you'll remember the two times in our history that we have did massive regulations, okay? The first one was in 1932 when we introduced Glass-Steagall, which broke up the banks. Because in the Central Banking Act of 1913, basically the banks were able to merge together. And there are two versions of a bank. historically in America. You have a lending institution and you have a investing institution. And when these banks started merging together in the late 1910s and obviously throughout the 1920s, basically they created an environment where if you put your money in the bank, the institution, you put your money in the lending firm, i.e. the institution, the trading firm at the bank would trade that money, over leverage that money, and take on a zero risk environment and create a fractional banking system that is not fractional banked at 10 to 1, but now 30 to 1. And historically, when you get to that type of over leverage where you only have $1 to cover $30 of debt, you can't come out of that unless you have some type of massive economic calamity. And that's what happened in October of 1929. Well, in 1932, the Glass-Steagall Act is the one that broke up those banks to where you had to say, okay, if you wanted to be a lending institution, then be a lending institution, lend people money, carry on a risk. And when a bank carries on a risk, they're not going to over leverage their bank. They're just not going to do that because they have a risk. And if you want to be a trading institution, fine, be a trading institution, but you can't lend out money because there is a conflict of interest there. Because what the banks can do when they bring it together, they can really cover that risk, which encourages them to lend out more money and more money and more money, because they're always going to cover the risk through the bond market or the CDO market or the money market or whatever other product they create to that is basically a derivative product, a bond product or something along those lines. The second one happened in the Great Crisis when we eliminated Glass-Steagall in 1997, 1998, and that led these banks to merge once again together and create an over-leveraged environment.
The proof's in the history. You had how many years, almost 70 years, 60 years without incredible bubbles that pop. I mean, you had a couple cycles that got bigger, but they're blips on the radar.
And Bernanke.
Compared to the last 20 years. We've had two big bubbles pop, and we all know the third one's coming. It's a question of when.
Well, and I get it, Noah, but when the markets are going up 200, 300, 400% in a cycle, it's fantastic. But when those bubbles burst, it causes tremendous economic and tremendous emotional pain to Main Street America, who doesn't necessarily participate in that 400% increase in the S&P 500 that we've seen in the last 10 years, or the subprime market or the dot-com market. And it goes back to what Alan Greenspan and what his belief system was he was an understudy of Ayn Rand, who truly wanted to create these bubble-like impacts. And he was the central bank president from 86 till 2004. And he wanted to create these bubble-like scenarios where you see these massive price appreciations. And then when the bubble falls, it resets the inflationary cycle. And in Greenspan's words, that shifts all the money to the top of the market. In his trickle-down economic belief system in neo-capitalism, what Greenspan would believe is then it would trickle down to the rest of consumer America through wage increases, job creation, and so on and so forth. And even Greenspan has said in recent years, as he's getting a little older, he said it didn't work. So in my opinion, it's a difficult conversation, because I agree with Mark that whenever you introduce a regulation, you are decreasing a free market to a certain extent. But you've got to make this market a market that is free from manipulation as well. You cannot have a market that is just driven through central bank monetary policy and repo actions and so on and so forth. Maybe I'm old school, but I miss the days of supply and demand. I just do. That's why I love.
Well, we're old enough to remember them, perhaps, and so I think it does create problems, and it does create that boom bust cycle, which I think shakes people's confidence and in their desire to want to participate in that American dream, and that you can invest for your future. Because if you can't invest for your future, that really hamstrings people. So, I think regulation is necessary. It's a question of how much. And I always think there should be a statute of limitations, because you got to revisit whether or not it's working. That's the biggest problem. Whenever you give government too much control, they're really bad at regulating themselves.
Dodd-Frank is not working right now. Either one, back in the day, they didn't go far enough, or they went, or they basically tried to split the middle in Dodd-Frank. And then Dodd-Frank was never really it didn't really have an impact, because the regulations started coming away from it immediately. The central bank reduced regulations on Dodd-Frank. The government has introduced executive actions on eliminating some of the regulations on Dodd-Frank. And that just call me crazy, but in a world in the last 10 years where we have gift wrapped trillions and trillions and trillions of dollars to corporate America and Wall Street institutions, in a zero interest rate environment, in quantitative easing actions, in repo actions, I think they can afford to pay their fair share when they have true Wall Street socialism right now. So I do believe we have to have regulations. I do believe we have to have honest conversations with what these Wall Street institutions do. And I'm going to tell you right now, if I was president for today, I'd bring back Glass-Steagall. I'd take it far. I'd break up the banks and make sure that the lending institutions were lending institutions and the investing institutions were investing institutions. Because my belief is when you combine these two banks together, and this is just my belief, it creates an environment where you lose capitalism, not apply capitalist belief system. And I'm an Adam Smith capitalist, Mark. You know that about me.
Well, you got to remember Adam Smith wrote another book called Moral Sentiments that was really the foundation and framework for Wealth of Nations. You got to have some moral objective laws that keep the foxes from watching the hen house.
And even Adam Smith would say the conversation over regulations is a difficult conversation, but must be had. And at the end of the day, Adam Smith believed in two regulations. One was to regulate monopolies and guard against monopolies, and the other one was to guard against the banking sector, because our founding fathers and Adam Smith wrote that great book, Wealth of Nations, in 1787. They were influenced by social contract theorists like John Locke, Thomas Hobbes, and Henry Rousseau. And there was a moral compass to this. And I just simply believe that the moral compass has failed at the Wall Street and the corporate level. And we need to rein that back in. And we need to do more for consumers. People need to fight for people. And with that said, we're going to end that conversation on Dodd-Frank, Glass-Steagall, banking regulations. Hope you enjoyed the halftime report here today from Tackle Trading. If you enjoyed the report, make sure you give us a nice little like and share. Get the word out there. We know you guys are telling family and friends because you see our subscriber growth happening. So I really do appreciate Team Tackle. We're a small community, like-minded traders and investors coming together to help navigate this financial world together, because it is a big, big world. So I hope you enjoyed the halftime report here today. If you are not a member of the Tackle Trading Pro member community, you can get a free trial by emailing team@tackletrading.com. You can also go to tackletrading.com and sign up for a 15-day free trial and see what the rest of our pro members really enjoy about this community and about the content that we provide on a daily, weekly, and monthly basis. And last but certainly not least, go to tradingjustice.com, please. We just released the latest edition, episode 361 of the Trading Justice podcast, where we went through the market skyline, had some debates there. We also brought on the great Jake Pelly, and he's been a guest on the podcast before, but I just absolutely love Jake, love his story, love everything that he represented when he was 25 years old and got an inheritance from his father, and he didn't want to lose his inheritance, and he sought out education, financial education. And he basically, over the last 10 years, he's a stay-at-home dad. He's a father now, and just updating people on his journey I thought was a really, really cool conversation. And then we had a nice little game yesterday during President's Day, where Mark asked us to name the president. And shockingly, I think you guys all know who got back on the winning streak. So I hope you enjoy the podcast. Give us a 5-star review on the podcast if you enjoy it. Really appreciate that as well. And with that said, guys, we are out.